Here we go. Show of hands, who was here roughly a year ago for the last time Stephanie was? Oh, wow. There you go. Who wasn't? Who's freeloading on the good market? All right. All right. For the rest of the brave souls who came out when the world was ending, this is our third time with Stephanie. Every time I say, do you want to keep going? You guys respond yes, so we'll see how it goes. I'm going to mark time here. Okay, 5:45. So we're going to talk about a crazy year to date. What, God help us, might lay ahead in the back half of the year. And then I solicited some questions from the team, trying to help us get into Stephanie's mind and how she thinks and makes, and the team did a wonderful job. So we'll go through some of those questions as well. So coming into 2026, 3 epic years. Maybe the dot-com era had a greater total return over a 3-year, but it's up there in terms of a 3-year return. What kind of was your mindset coming into the year? I know you talk a lot about the acronym TGIF and kind of what that stands for is what's developed, but yeah, where were you thinking coming in? And as to the acronym, what's really played out here over the first 4 months of the year?
Yeah, well, and thank you for having me, and thank you for coming. And thanks for the weather. It's beautiful here. We haven't had that weather in New Jersey just yet, so. So Tim, we were talking earlier today, and I said, if you asked me in January that we would have Venezuela, we would have SCOTUS, reverse the tariffs, we would have AI collapsing software stocks, private credit concerns, and a war, what do you think what the market would do in that environment? I would have thought we would be down double digits. Does anyone know how much the market is up year to date? We're up 4%. In the face of all
5
of that,
after today.
Maybe 5
5,
after
yeah,
today.
yeah.
Maybe. And you know what? Apple will help, and that will probably be up 6 tomorrow. We're also up 12% from the March 30th lows in the S&P 500, and we're up 17% in the NASDAQ from the lows. So we've had a remarkable year so far, to your point, in the face of all this uncertainty. And I think you probably heard me say this last year, the market always climbs a wall of worry. I worry when I don't worry, because that means you're complacent. And we're always going to have things, like you mentioned TGIF. I coined that last year. It's tariffs, it's government, geopolitical issues, it's inflation, it's the Fed. We still don't have a lot of answers with regards to TGIF, and yet here we are. We're up 5% on the year. We're up 18% last year. We were up 24% 2 years ago and 23% the year before that. And so why is that? Because the economy has done remarkably well in the face of all this unknowns. So what is leading the economy? It's 2 things. It's the consumer is actually consuming, believe it or not, and that's because they have jobs. I look at, we can talk about all various different indicators that I look at, but weekly jobless claims are at historic lows. We had a number today, weekly jobless claims, that was the lowest since 1969. Low is good, right? High is bad, low is good. Recession is 350 to 375,000. We are well below 205,000 on like a smoothing basis, like over the last 3 months, because like weekly data is weekly data, but I smooth it out so that we can get the trend. And the trend is that the weekly jobless claims are really very, very good, and that's positive, and there's 1 job available per 1 unemployed person in this country right now. So if the consumer has a job, they spend, and they are spending, and we got personal consumption data today that showed that. We got retail sales numbers that showed it. We're a nation of spenders, whether we have the money or not, to be honest. So I've learned the hard way, never ever bet against the consumer. And they are consuming. And they're consuming in services, which is good, right? Consumer is 70% of the economy. Services is 75% of consumption. So those are the 2 things you root for. And we're doing a really good job going out to dinners and going to events and going to concerts. And I was on a plane yesterday and it was mobbed. And the airports are mobbed and hotels are, the prices are crazy because there's so much demand. So there's that. And yes, before you ask me, but it's K-shaped. It is K-shaped. The high end is doing well, but the high end usually does well. Why? They have houses and they have equities. And those are the two things that are driving their wealth. And so the middle and the lower end are not doing as well, so that's why it's a little uneven, but it's like the 80-20 rule with regards to the upper end consumer doing all of the spending. So that's number one. Then number two, and we can go into this in a lot more detail, what's really driving this economy is AI. AI, we are in the second inning, and it's not just AI. It's not just Mag 7 that are spending, because they are spending $761 billion this year alone on AI. That's the Mag 7s. They're spending, but it is impacting an entire food chain, what I call. So, if you believe in AI, which I do, I think you should too, you need data centers. We don't have enough data centers. We have 11,400 data centers in the world. We need 30,000 data centers by 2030. We don't have enough data. So think about the data centers, the companies that actually build the data centers. They build stuff outside the data centers to make it, just to build the buildings, but then they also have to build the cooling systems, the heating systems, all the racks that all the technology can sit in. So the industrial companies are booming right now. I've never seen backlogs from the industrial economy like I've seen on this particular theme. So if you believe that, then you have to believe that the grid needs to be repaired because we haven't spent money on the grid in over 50 years. Incremental money, 75% of the grid is over 25 years old. So you need companies then that are spending on upgrading the grid. Utilities. So now I have technology that's winning, I have industrials that are winning, I have utilities that are winning, and then power needs to happen. We don't have enough power. And that's why you're hearing all about other options. Natural gas, I think, is the big winner, but we don't have enough pipelines. So we've got to build pipelines. Nuclear, it'll hold a place, but it's not going to be mass production of nuclear facilities at all. We might revive a couple of the nuclear plants, but it's going to be very hard because it's a regulatory nightmare. So you have that. I think coal will also be important, and then regular energy companies. And why do we care about any of this? Because all I care about as an equity portfolio manager is earnings. Stocks follow profits on the way up and on the way down. And the last 3 years, earnings and the revisions have been remarkable, and they're still going up even this year. You had mentioned, you saw a 16%.
14 to 16%.
16% number, and we're actually growing right as of now. We've only had about 50% of companies report just this past quarter. You're running 25%. So I'm not saying that we're going to grow 25 forever, and I don't even know if at the end of the day and at the end of this year we will be at 25, but I know we're going to be higher because of these two important pieces of our economy. And we do get data on a regular basis from the Atlanta Fed. They actually put out what they call the GDP Now tracker. It's way too complex. Don't worry yourself with the Atlanta Fed tracker. Let us worry about that. But basically, it's just real time. They take all the data points, they put it into a computer, and they spit out a number, and you get the real time growth rate. And it's not precise at all, but it's the direction that we care about. And pre-war, we were running at 5.3%. We're slowing a little bit because of the war, because of gasoline prices, because of inflation, all that stuff, I get it. But the number came out today at 3.7%. And a lot of that is because we have the one big beautiful bill. Whether you think it's beautiful or not, it's stimulative. It's going to add a percentage point to GDP, and I think it's helping to offset some of the friction from the higher inflation numbers. So we'll have to see. Not everything is perfect. I worry about everything, the TGIF and a lot of other things, and we can talk about it, but we're in a pretty good position right now in the economy, and that should lead to better earnings, which should lead to higher prices. I'm not thinking that we're going to grow 18% in the S&P 500 this year. but I'd be happy with 10, and the long-term average is 7.7. So if we could do a little bit better in a year where there's all these uncertainties, if we could do above trend, that's pretty exciting.
Talking about concerns, one of the things that was dominating headlines, maybe started percolating last fall, based on the amount of emails I got, was hitting a fever pitch maybe a month or two ago. Private credit. So you and I both agree, a lot of money went into I think all things private, a lot of new vehicles. And with that, actors get in that maybe aren't as prudent as they should be. Maybe they shouldn't be in the space at all. You recently, I think just Monday, had Torsten, you guys did a podcast together, Slock, who you guys have heard from Apollo, chief economist. He points out to all the people trying to analogize it to '08 that it's 3% of the debt market held almost exclusively by institutions and high net worth individuals. '06, '08, the real estate, 60% of debt was mortgage debt between households and businesses. So much bigger issue. But what's your take on private credit? I guess valid concern versus systemic risk.
Yeah, I mean, I don't think it's systemic risk. I do think we had some bad actors. I do think we saw fraud in a couple of those bad actors, but I don't think the big companies are in that position at all, and they're very diversified. And as you mentioned, it's a very small percentage of overall debt in the industry. What I will say is I think that there are a lot of people that are in these vehicles that didn't know that these vehicles were illiquid, that you had to hold on to these vehicles for 7 to 10 years. And so I think you have some people that are nervous. I get it, rightfully so. I think you have some...
Not the one you guys are in, by the way. Just save us some emails.
Not.
You're not locked up for 7 to 10 years.
Of course not.
So.
But a lot of them are, and I think a lot of people didn't realize that that you can redeem, but that these companies have a limit on what you can redeem on purpose. It's not positioned for a short-term
It's a
investment.
feature, not a flaw, was what I heard a lot back at your conference, to protect investors, not to try to hamstring them.
But I think there are a lot of great ideas in private markets, in alternatives in general. I think it's a great diversification tool. You just have to know what you own. And I will say that even the big companies did have exposure to software companies. And there is a real change happening in software because of AI. Software is not going away, and mission-critical software is certainly not going away. But there are some companies out there, smaller companies, non-profitable companies, even some of the mature software companies are going to have to change their business models. And so there is a bit of disruption in software. But again, I don't think it's the big companies that, the private market companies where they're investing, they're not really investing in speculative software companies at this point. So it is certainly out there, but I don't think this is anything close to 2008.
Talking about really the whipsaw, maybe the confusing market year to date, certainly a question we get, happy to take, which is, man, it doesn't feel good out there. All those things, those disappointments, if not outright, at least to relative expectations that you outlined a little bit. Yet here we are with the markets. A couple of your CNBC buddies that for those of you who read the commentaries, you would have already gotten this information. But Tom Lee talks all the time about V-shaped recoveries, that the pundits that say, it'll take a long time to work out of this, sometimes from an economic perspective, but markets actually rebound really quickly. Josh Brown's team put out a great piece kind of speaking to the reality I think those of us as financial advisors live, which is, people might miss a few bips, but once you get to 5+%, then they start waiting for the next big one. And we hear it frequently, like, when it feels better, things go back to normal, I'll get back in. And I always wonder what their normal lives look like, because I haven't gotten to live that. But you'd miss out on 83% of the market's returns if you got out and then tried to get back in once things had recovered to their prior levels. What do you think explains that disconnect? What do investors miss around how the market thinks and processes information with respect to prices, to how we feel about it on an individual level?
Well, it's real money, right? It's your savings, so it's emotional. And it's really hard to buy when things are going against you, meaning buying low, selling high. Most people say they do. Most people buy high and sell low. Sometimes I do it myself, right? We're only human, but I like getting my shoes on sale. Why shouldn't I like getting a stock on sale? But it's very, very challenging. But here's a couple of numbers for you. So first and foremost, the spring, each year, it's a seasonally soft period in the markets overall. So like end of March, think early April. You could even say March and April. They're the second worst period of the year for the markets. September is the worst. So if you know that, it doesn't take much for the markets to kind of go a little, haywire for a bit of time during these seasonally soft periods.
Not that you're encouraging people to time that.
No. But what I am saying is if you sold on March 30th, which was the low in the S&P this year, you would have missed 34% recovery in the S&P. If you sold back in 2023, does anyone remember when Silicon Valley Bank failed? Okay, if you sold in the spring of 2023, you would have missed 78% in the S&P recovery. And if you sold in the spring of 2020, which was COVID, you would have missed 198% recovery. So I am definitely not telling you to time the markets. In fact, I am a huge advocate for dollar cost averaging. I do this for a living, and I think dollar cost averaging is the best way to be in the market. So you take the emotion out of it, and you can supplement it with active management too. But it's very, very hard. And then what I always say, and I said this last year too, when it gets really uncomfortable and you feel really exasperated with the markets and the economy and all the news, turn the TV off, because negativity sells. By the way, I want you to watch me, but not that badly. Seriously, like negativity sells and positivity is boring. I mean, I think some of the biggest debates that I have on TV with some of my colleagues on certain shows is because they sometimes go over the deep end on being negative and trying to time it. And it just doesn't make sense over the long term, especially if you believe the numbers, and the numbers are the numbers. 7.7% for equities, 3% for fixed income.
Your close your eyes idea or shut off the TV reminds me of a commentary I did 4+ years ago. We go down to Disney World, and Isla, who's then 3, says she'll go on the Slinky Dog roller coaster. I was highly impressed. I still am pretty impressed. And we get off of it, and I said, well, how did you make it? That was incredible. It was actually a decent little roller coaster. And she's like, well, I had 3 things. And it turns out to be great advice, I think, for investing, which is why I shared it in a commentary. It's like, number 1, I had my seatbelt on. And so, yeah, that's probably your diversification. Number 2, I had you, Daddy. I have a partner. And she's like, and then number 3, when it got really scary, I just shut my eyes, which,
I love it.
I think you get those moments where you're like, hey, look, this thing is not comfortable. You're not enough. This thing's not helping my stomach. I'll just shut my eyes. So.
And I think if you read a lot during when there's a lot of uncertainties, read a lot of different things. You could read bearish reports, but find some bulls out there too. Learn both sides, because there are 2 sides every time, right? There's a buyer and there's a seller. And then find the people that you like and that you trust, that can keep it simple so you understand. But one thing that gave me confidence to be adding by the way, I was buying in the beginning of March, so I wasn't buying, I was buying all throughout March, so I didn't feel so good by March 30th myself. But one thing that gave me confidence was the bank companies. So the big 6 bank stocks, J.P. Morgan, Morgan Stanley, Goldman Sachs, Citigroup, Wells Fargo, Bank of America, all of those companies, they spent a lot of time throughout the month of March talking at conferences. And all of them said very similar things, which gave me confidence. 3 things. They said the consumer remains resilient in the face of the decline, this is the real time, they're on the front line, they see, they get credit card data, they get all kinds of data about the consumer. They said the consumer is resilient. I was getting really tired of hearing that word resilient. I'm looking for like a thesaurus right now just to try to find another name, but the consumer is hanging in there, number one. Number two, credit quality was actually improving. Delinquencies were going down, net charge-offs were going down, non-performing assets down, provisions actually down. That's a good thing. You wouldn't know it if you heard TV and listened to people obsess about where the numbers are, and they're historically low delinquencies right now. And then the third thing they said, most importantly, is they're lending more. And that wasn't a surprise because I look at a lot of data, weekly data from the Federal Reserve. They put out all kinds of lending data, deposit data every week. And so I kind of obsess about it just to get a trend. And on average, loan growth was running at about, in March, running at about 8%. Since then, the companies have reported earnings and there were anywhere between 8 to 10% in terms of loan growth. Why do we care about that? That is the lifeblood of our economy. You want the banks to be lending prudently. And a lot of the reason they're being able to do that is because of the administration's deregulation policies. I think, and I know from the numbers, that they are taking, the public bank companies are taking some share back from the private market companies. The private market companies had a field day in 2008 because they were not regulated and they were the ones that took all of the market share from 2008 to 2020-25. And now I think you see the big banks are starting to at least push back a little bit, and they're lending again, prudently. Deregulation is not going away. They're going to still have to hold a lot of excess capital, but they have a lot of excess capital, and they're deploying it. And that is one of the things that I felt really good about, that if the banks felt good about what they were seeing, I should feel good about the economic data and the implications. And so when stocks sold off really hard, I felt like the way I invest is I think about a lot of themes. We just talked about the AI food chain theme, cybersecurity theme, a lot of other I have 20 different themes. I promise I won't go through them. But I like to have themes so that when the market does correct, I look for stocks that are those themes. And you look for opportunities. And the best thing about a sell-off, even though it sounds funny about it being a best thing, the best thing about a sell-off is you get to find the number one company in any given industry that likely falls because the whole market is falling. And you get to own number one on sale. And that's something that's pretty exciting.
Another big news point coming up is the new Fed chair.
Yes.
Yeah, we're 25 minutes in. We're on the other side of food and alcohol. But let's talk about the Fed just a little bit. What, interestingly, and again, we shot some commentaries around this earlier today. You obviously have better sources than I, but some actually pretty positive outlooks on him. But he's wanting to usher in a whole new regime for how things have been. What can people expect?
Yeah, well, first and foremost, he was at the Federal Reserve in 2008, and there are some executives in the industry, in the bank industry, that would say that we would not have gotten through 2008 without Kevin Warsh there, that he is a genius. I don't know him, I've never met him, but I like what I hear. I think he's going to have a doozy of a time corralling the 12 Fed governors that vote, because they're all over the map right now in terms of their opinions and what they want to do and what they don't want to do. I don't think they're going to be cutting rates anytime soon, but the market's not expecting them to do so. The one thing you and I were talking about earlier, and I know we agree on, is I just hope he gets in there and says, you know what, governors, you're not allowed to talk every other day to the public. Because it's so confusing. It's confusing for me, and it's got to be confusing for all of you too. I like to listen to them because they're smart, but I don't want them to be every other day nitpicking at one data point or another. I don't even really care that much what each of the individuals say, But I do like to listen, but I don't care exactly what they say. It's a collective group. They have to vote, and I think that's what Warsh's issue is going to be. I think it's going to be hard, and it's going to take a while, and I think he will do a very good job, though. But here's the thing. So I just mentioned that we were growing 5.3% pre-war. We're growing 3.7% today, and we haven't cut in a while. We don't need to cut. The economy is really doing quite well for a number of reasons, of which I already talked about, and a lot of other things as well. So we'll have to see what happens, but I just hope it's just more quiet, you know?
Yeah. I think with the recent market gains being so strong over the last few years, and it became a talking point, I think with some validity a couple years ago, we certainly wrote about it and warned about it, which was valuations, particularly amongst the tech side, which had a lot of 40, 50, in some cases even higher multiples. I'll hear that. People come like, well, but the market's overpriced.
Yeah.
It's really not anymore. You look up, and I think we all can get guilty of trying to track all the various variables, but most, even the Mag 7, 20 times earnings, arguably pretty inexpensive. How do you feel about market valuations? You're free to disagree with me. Now, we kind of touched on earnings, but where do you see opportunity? Is it in the tech sector? Is it broadening out, or is it both?
Well, the interesting thing over the last 3 weeks is that earnings estimates from strategists on Wall Street have actually been going higher. As we mentioned, 14 to 16%. We're growing more than that right now. We'll see where it all settles out. But that's what's been interesting in the face of all the unknowns. And at the same time, the market multiples have corrected from 23 times forward estimates to 19 times. And a lot of that is because tech went from 40 times to 20 times. I think there's a lot more, I think there are a lot of opportunities. Yes, certainly in tech, especially since we just got a whole bunch of the Mag 7s this week, and they're growing like weeds. So I think you want to be there. I like the free cash flow stories. I understand they're spending a lot of that to fund AI. I think they should be. If you listen, you have to listen to or read. The CEO of Amazon, Andy Jassy, wrote a shareholder letter, I think it was 2 weeks ago. And it went through why they are investing in AI, what the opportunities are, and when they expect to see returns. It is a fascinating letter just to learn. So I think you want to have exposure to tech, but I think you also want to have exposure to other sectors as well. I mentioned the banks. The banks are quite cheap, and they have a lot of excess capital, and they're returning all that capital to shareholders, and they're growing. I think the industrials, as I mentioned, this whole AI thing is a real thing, and I've seen backlogs anywhere from 60% year-over-year growth to 160% in year-over-year backlog growth in these industrial companies that are part of this whole infrastructure build-out. And oh, by the way, that does not include the onshoring and reshoring that the administration wants companies to do as well. So I think the industrials are a real interesting place. Transports are interesting. They've done well. Transports are a leading indicator, and they're starting to do well. So like rails and trucks, that sort of thing. So I think that's kind of interesting. And then the one sector that's a little disappointing that I think should do better are the consumer discretionary stocks. They haven't really been able to catch a bid for a sustainable period of time, but we got some encouraging commentary from some of the restaurants this week and some of the airlines too. So I think that might be a sector that starts to participate. But I like the broadening.
I heard Olive Garden's even back.
Olive Garden is back? Are you going? Is that where you're going?
No, but yeah, it was a great article the other day.
I'm
like, this is. I didn't know they were gone, but they're back. Is what I heard. Last words on the markets before we go into some of the team questions.
I mean, I think we hit on a lot of things. I mean, I think I think what's also interesting, not on the equity side, is the bond market. I mean, and credit spreads. If things were really going awry, you'd see a blowout in credit spreads, and we're not. They're at record tightness. That's number one. And the 10-year has been in a range, like a 7 basis point range in the past year. So if things were really haywire, we would see a lot different action.
The hard part, and we've put this in a lot of the commentary, like this is really geeky, boring stuff for the credit spreads.
I know.
And so it doesn't end up on TV. So people, they grab to a private credit story. Meanwhile, if you actually talk to the banks, like actually things are getting better and these numbers are improving. And it's always kind of interesting to watch the public narrative and then what's happening behind the scenes.
I do think there's also some opportunities internationally. I am worried about Europe, so I would not go there because they're so dependent on oil. And by the way, we're not, which positions us much better. But I think there are some opportunities. Last year I mentioned India. I still like India for the demographics. 1.4 billion people in their economy, and you have a very pro-business, pro-growth administration. And Prime Minister Modi is working endlessly on the infrastructure. They're going to spend $1.7 trillion between now and 2030 on infrastructure. I mean, if you talk to Tim Cook, who's the CEO of Apple, he has said in the past he wants to build 1 out of every 4 iPhones in India. Right now they do 1 out of 7. They can't because the infrastructure isn't sophisticated enough. He said the ports, you can't even get the ships in the ports because they're not as sophisticated and built up. But one of my very favorite places to invest in is, and it's up a lot year to date, it's up about 30%, 25%, is Brazil. I like Brazil. It's the 7th largest country in the world, the largest in Latin America. They have 214 million people. The average age is 35 years old, so it's a young economy. You have a very pro-friendly government, fiscal and monetary-wise. Rates are still awfully high up there, but they are bringing them down. But what most people think is of Brazil, they think it's an agriculture and a commodity country, and it is. 25% of the GDP is agriculture. But what's interesting is they also have what everybody in this world wants. They have power. So it is a backdoor way of playing that whole global food chain. But I don't want to have a lot of exposure internationally. I mean, it's up to Tim and the 10 Capital team to figure out what the allocation and what you're comfortable with. But I do think that there are certainly some opportunities beyond here in the States.
I just watched the Ronaldinho documentary on Netflix today while I was on the treadmill. Great soccer down there as well.
It is, yes.
So we're going to go through these. We'll kind of have to rapid fire it because
Okay.
we want to leave at least time for a couple questions from the audience. When you have a high conviction stock or theme, how do you decide position size and when to trim it or add to it?
Well, I mean, I think buying is a lot easier than selling. I'll tell you, I'm much better at buying than selling. I tend to sell early, but you can never complain if you're taking a profit. I sell if my whole theory and thesis has changed. I'll sell out. I have a very concentrated portfolio. I have 30 names. And so on average, my position sizes are anywhere from 4% to 5%. But I have high conviction in them. Anybody that tells you that they can have more than 50 names in a portfolio and do it well, God bless them. It's hard. I know I can only do 30 at a time. I can do it well, and I don't even get it right all the time, right? So I think it all depends on kind of what your style is. The S&P 500 is 501 names, so you can go that way too. But if you're doing active, I think active, you need to have much more concentration.
When markets get noisy, how do you balance fundamental analysis data with your gut?
Well, I try not to let my gut get in the way of anything, but I would say, it's doing this a long time, 35 years, a lot does have to come into play in terms of what do you remember? Do you, have you learned from making the mistakes? Because everyone makes mistakes, but you try not to do those mistakes over and over and repeat those. I think that's kind of the way I approach it. I just try really focus on the fundamentals, because that's something I can control. I can learn as much as I possibly can about each company, each industry, the macro, having themes, and focusing on companies that support those themes.
Now, I know you use your gut instinct because we've talked about this the same way I do, which is basically you do whatever you feel like not doing, right? So
that
I
is
remember your analogy of
That is true.
crawling under the table and just hitting the buy button
For
from
sure.
underneath the desk.
For sure.
Specific to individual investors, retail is the industry we call it, what risks do you believe they're underestimating today?
I think that
Or a risk?
Well, I think that the market, even though it's broadening out, most people still own a lot and have a lot of exposure to technology and Mag 7. It's 35% of the S&P 500, so you're going to have a lot of exposure. But I don't own 35% of technology. I just don't think that that's the prudent thing to do. I can find a lot of wonderful companies and still beat the benchmark and still do well. But I think that the problem with and it's not a problem. I mean, people that own the Mag 7, they've been great investments, but people have such embedded gains, they haven't really been trimming. And so I think that people have an outsized exposure to the group, which bothers me. I think they're great, but I just think that the percentage of ownership is really enormous.
All right, do two more and then we'll kick it to the audience for two. What is the biggest risk to markets not being discussed?
I don't forget what I told you this afternoon.
No, it was good. Check out, that's our teaser. Watch this week's commentary.
I would say momentum. A lot of people invest in things that are going higher, and the valuations are really extreme. Momentum is wonderful when the stocks are going on the way up, but once momentum reverses, there's no valuation support. So be very, very careful about chasing stocks. It goes back to the whole try to find a better buy point and entry point, and try not to chase at what everybody likes. When everyone's on the same side of the boat, it's very hard to make money. So you don't have to be on the other side all by yourself on the boat, but you're somewhere in the middle.
Last question, great question. Where are we in the investment cycle currently, or have the classic cycles seen a structural change?
I think we're seeing a structural change right now because of what I've talked about in terms of AI. We're in the second inning. This is a revolution. This is impacting so many companies in so many ways. The spending is not ending anytime soon. When it does, we have to have a conversation. But we have companies that just this week told us they're raising their capital expenditures for AI. I mean, I've said it before, chief technology officers, I interview a lot of them, including Hightower's chief technology officer, and they will tell me they spend on two things. They're spending on AI because they still don't know what it means for their business. Enterprises really haven't adopted very much, and there's a long way to go there. And then the second place that they're spending is cybersecurity, because they can't afford to wake up and lose their business. And I'll tell you, cybersecurity is going to be bigger than AI. Because of AI. AI is not secure, and more companies, sorry Tim, more and more companies are using AI agents to code, and that is a recipe for a security disaster. And lastly, there are a lot of different companies out there in cybersecurity. There's this company called Palo Alto. It's one of the big five. The CEO just bought $10 million of his stock.
They've struggled of late, which is kind of interesting. They've struggled of late.
The whole sector has struggled of late because they're getting wrapped up in the whole software is going to kill them. And that's just ludicrous. But I like it when you see CEOs, back their conviction with them using their own money to buy, because they obviously think it is important.
Yeah. All right, where's the mic? This guy's a troublemaker, so we gotta be nice.
In your theme of AI, of which this has a whole host of questions for me, but recently the CEO of NVIDIA came out with, he coined the phrase physical AI, meaning,
yeah.
Okay, so you're familiar with that?
Yes.
So if you could maybe delve into that as to where you see that going, and as to other companies that might utilize that and the future of that?
Well, I think it's exactly what I was saying in terms of the food chain in general. And it has everything to do with it's the data centers, it's the grid, it's power. These are the companies that these are the industries that we need to be building so that AI can grow can thrive.
Component aside, not the infrastructure of the AI data centers, who's going to utilize the AI and physical components in our physical world? Do you understand that?
No, I think I think that's the way I understand it to be in terms of the physical AI. It is really more of the infrastructure part of it, and it's also the energy component too. I don't know, maybe he was talking about something different, or I'm thinking about something different. What?
Automation and play into automation.
Oh, okay, sure. I mean, I think automation and robotics is a huge, huge theme over the next, 25 years. We have 4.7 million robots right now in this world. We're going to get to 155 million robots by 2050. Amazon has 1 million robots right now, and actually they believe that they aren't going to have to hire 400,000 people between now and the next 10 years because of robotics. It's a huge, huge theme, and I think we're just beginning. And there's a lot of ways to play that. You can play that via some semiconductor companies, because a lot of them are doing more in terms of robotics. But again, it's also some of the industrial companies that have automation and robotics. And I think that's going to lead to enormous productivity gains. And we're starting to see productivity
We
actually
saw today,
increase.
today, like only 0.7 of the productivity gains came from increased hours. Almost everything else was improved efficiency.
Yep.
So huge number.
I mean, if you could get above trend growth and above trend productivity, like that is a recipe for that's nirvana for the markets.
Should tamper inflation too, I would think.
Oh, 100%.
Yeah. All right, in the back.
Yeah, I'd like to get your thoughts on high oil prices. It seems we're kind of stuck in this $100 plus market. And I understand from a supply standpoint, the U.S. is in good shape, but our prices are driven by world markets. And when I read about the Strait of Hormuz and the issue with Iran, I don't see any resolution at all coming.
Yeah,
So I just wondered what you think about long-term oil prices, high oil prices, and how that might impact things.
Dan worked for Shell too, by the way.
Oh,
so he's a
fabulous.
He's a
Wonderful.
plant.
Why don't you answer that question, Tim?
I stopped answering Dan's questions a long time ago. He knows more about this than I do. I'm not going to tell him anything.
I think obviously everything's very fluid with the war. A lot of the commentary that I made tonight is based on the war being months, not quarters, not years. If it's quarters and years, I'm going to be wrong, I think, because I think higher oil prices, but not just higher oil prices, it's higher inflation. It's everything that feeds through into the system. A lot of the chemical companies are seeing massive price increases as well, and it's inflationary. So if we go on this war goes on for 1, 2, 3 years, then I'm going to be wrong. I have a hard time believing that this administration wants to go into the midterm elections with oil at $100. One of the things that he had going for him in terms of Trump on inflation was up until the war, gasoline prices really didn't rise all that much before COVID and then up until the war. That was one of the things that he could hang his hat on, that gasoline prices have not been, they weren't at the time, egregious. Now they are, and that's a problem. But I will say that household budgets today, in terms of gasoline, it's only 3% of their budgets. And a lot of that is because we have much more fuel-efficient cars and we have alternatives, EVs. And I think that market is going to continue to do better. So we are handling it for now. The consumer is handling it for now, but there obviously there's a lot of fluidity to this situation. So I'll have to just kind of keep an eye on it.
I'm going to come find you for your thoughts after the thing, because I would love to know. I did hear an analyst this week talking about it, and in terms of timelines, and yeah, maybe nobody knows, but he was talking about the number of different oil wells that Iran would have to shut off if they can't get that strait open soon. And at least he said once you shut these things down, you can't really start them back up. And so he's like, the clock is ticking a lot louder than probably the retail public. I hope he's right.
I think
Obviously, we'd
we're-
love to have resolution.
But I think the U.S. is in better shape because, we're not dependent on it, right? We are energy independent, and that's this whole drill, baby, drill thing. And that's what we continue to do here. So I think we're in better shape. That's exactly why I don't like Europe, and I'm nervous about Europe. And I know that it's a global world. We're all kind of interconnected. But I think we'll be able to handle it better than most.
Yeah, definitely. Well, thank you, Stephanie, as always,
Thank
for
you.
joining us. Yeah, please.